Welcome back to another episode. Today we are talking about interest rates, the latest news from the Fed, and what it all means for gold and silver buyers. Please take a moment to like and subscribe to keep the channel going. Thank you. Now, for those of you who haven't seen our prior videos on the subject, interest rates have wide and varied effects on the economy and on the topic most near and dear to our hearts, precious metals. Interest rates have an effect on the dollar, on gold prices, on the broader economy and loans, and therefore affects silver as well. Since March 2022, interest rates have been climbing at the most rapid pace in our history. Primarily, this is driven by the increase in the Fed funds rate set by the Fed. Now, this is the rate that banks loan money to each other, which then trickles down to the consumer. If banks must borrow money at 5%, it means your mortgage might be around 7%, for example. As interest rates go up, the dollar tends to strengthen, and gold prices have an inverse correlation with the dollar as well as an inverse correlation with real interest rates. So let's talk about the dollar first. If the dollar strengthens, gold prices tend to go down. And for real interest rates, you can calculate that by looking at nominal rates and subtract inflation to get the real interest rate. If real interest rates turn negative, gold prices tend to perform strongly. And when real interest rates turn positive, gold prices tend to go down. Now, what's interesting is that we have been in a period since March 2022 where nominal rates have risen pretty dramatically, and real interest rates went from negative to positive, and yet gold prices are very strong. And this is partly because the rapid increase in rates caused a banking crisis this year, which resulted in a massive flight to gold. We've also had very strong gold buying among central banks, which helped prop the price up. Now, silver price does like to follow gold to an extent, but there's a huge industrial demand component to silver that puts investment demand to shame most years. If interest rates are going to weigh heavily on the economy, we expect that to negatively affect silver. So from this crash course in metals and interest rates, you probably see why there is so much interest among gold and silver bugs in what the Fed is doing lately. The last Fed Open Market Committee meeting, or FOMC for short, was July 25th to the 26th, and they met a month later at the Jackson Hole Symposium on August 25th and delivered some remarks. Their next meeting will be September 19th to the 20th, and we're expecting to hear a summary of economic projections at that time as well. The latest statements from the Jackson Hole retreat were received with mixed interpretations, and that may be because the data is mixed. The Fed's job is to bring inflation to a 2% goal. That's one part of their dual mandate, and it was Powell's primary focus in his prepared remarks. To boil down his 15-minute speech into a short summary, he gave a measured outlook on the Fed's data, acknowledged that parts of it have a lag time, that there may be some further impact from the actions they've already taken. He said they would assess the totality of the data before making further decisions. Now, some analysts viewed this favorably as an indicator we may be near the end of the Fed's current tightening cycle. However, at the very start of the speech, he also said they are, quote, prepared to raise rates further if appropriate. A few areas they're worried about include a stronger than expected housing market, labor market, consumer spending, and GDP. Investors have been overly optimistic about the Fed's policy stance in the past. It was just a few short months ago that analysts were declaring the Fed must reverse course as they had broken the US banking sector. While we did have several notable and historic banking failures, the Fed maintained its stance and continued to raise rates. They have also said they would be adopting a higher for longer approach, and we do not see their more recent statements as an indication they are changing the course. Nothing's set in stone, but a conservative and level-headed interpretation would be that we will not see an easing of interest rates for some time. Now, generally, if that's correct, we might expect that to weigh on gold and silver prices. Gold, because a strengthening of the dollar and a positive real interest rates, and silver because of weaker economic activity tamping down on demand for industrial use. However, we've had rallies in metal prices during periods of time where interest rates were increasing, which highlights the complex nature of our favorite commodities. In November 2022, gold spot was below $1,700 an ounce. It surged to almost $2,000 an ounce in January of 2023 before the banking crisis occurred. This was underpinned by central bank gold buying, an expected recession, and less hawkish statements from the Federal Reserve. Just the rumor of lower interest rates contributed to a stronger gold price, proving that the adage, buy the rumor, sell the news, applies to more than just stocks. And remember that global spending on gold is set to rise this November with Diwali, the Hindu festival of lights. There's also a chance that China does come through on their somewhat vague promises of stimulus for their ailing economy. If the Chinese economy does get a lift, then we would probably see increased gold demand from China as well. Not to mention, there are still some potential catalysts, like the commercial real estate apocalypse that has yet to fully materialize, and that could also spur metal buying. Stronger demand should lead to stronger prices. So how can you use this information? Well, we can acknowledge that the Fed's stance may weigh on precious metal prices for some time yet, but without discounting the fact, there are other variables affecting gold and silver prices. If you're buying with the intent to hold long term, then short-term news should have little bearing on your investing decision, and you should invest when you're ready and able. We hope the information provides context to the way prices move and some reassurance if overly optimistic near-term forecasts do not hold up. It may be these forecasts were created in the belief that the Fed's tightening cycle would end sooner, for example. If prices trade sideways for a while or don't hit targets you expect, this information might clarify some potential causes as well as future price movements. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.